I'm Chad Seegers. Let's look at a few key data points the markets are digesting right now and weighing heavily on investors' minds. The first is the inflation number that came out today. Inflation came in year over year at 8.3%, which is a historic high that we haven't seen in over 40 years versus the 8.5% that we saw in March, which does suggest that inflation could have possibly peaked in March. However, it caused a downturn in the market. Why? The expectation was for inflation to come in at 8.1%. We overshot at 8.3, and the market's very sensitive to any data reading right now that is below expectations, including earnings. You do have some data to support a possible top of year-over-year inflation in March. The second biggest contribution to the inflation we've all experienced has been the price of used autos. You had a competing car buyer with rental car companies, which sold all of their inventory during COVID, and then was a competing buyer as people began traveling domestically. We've now seen the largest decrease in 1 month price change for used autos that we've seen since 1968. Used autos were down 3.8% in April. In fact, we've now seen 3 straight months for prices of used autos coming down. This is a very positive sign. This is typically number 2 or 3 carrying costs for most households. The next contribution to inflation that everyone is sort of aware of is the price of oil. Oil was about a third of the CPI contribution increase that we saw, and you had oil that went from $58 a barrel a year ago to $123 a barrel in March. It's a 114% increase. You'd need to see oil around $224 a barrel from here, among all other inflation assets remaining roughly stable, to repeat this 8+% inflation reading we just had. Remember, inflation is what happened to prices on the trailing 12 months. It's not what prices are going to do moving forward. This has, however, affected the equity markets because companies obviously have input costs that they have to absorb with higher inflation. We had multiple retests of the March 8th lows, then hit again in late April. And this week, we've now broken through, especially with the inflation reading today, what is called technical support, sitting around 46.3. The next psychological level you have is for a 20% market sell-off. It's not much further than we are here. Put the S&P around 38.69. Historically, you have seen buyers enter the market around a 20% market correction, so you could see a relief rally. What's driving the market down is kind of interesting. The S&P 500 that we see on the news every day is an index that is weighted based on market capitalization, meaning the largest companies have a bigger share of the index. Currently, those top 10 companies, the famous FANG companies that we all heard about for years, they're trading at an expensive valuation relative to the rest of the market, and roughly 30% of the market cap. The remaining 490 companies of the S&P 500 are actually trading below long-term average valuation. They're sitting here at 97% of their underlying valuation with pretty robust earnings. And so you have a situation where the large companies that were fairly protected, the Amazons of the world, the Googles of the world, Meta, Facebooks of the world, and Microsofts of the world, they didn't feel the drawdown that the remaining companies, especially tech companies, felt earlier this year. Now they are. Therefore, when you have the largest 10 companies feeling the sell-off, the other 10, 490 companies are, it's going to bring the higher level index itself down to a price at this level. So you have some rallies that you could see for smaller companies with tech companies that have been beaten down already. You can begin to see a rally in those names at this level. Now let's look at the bond market. The 10-year Treasury yield briefly climbed above 3.1% before finally falling below 3%, which gave the bond market itself a rally. As those yields fall, prices go up. And so the abrupt rise in yields this year has been the thing that's hurt bond investors the most. With the inflation reading cooling a bit month over month, that looks to have given bond investors a little bit of hope here. The other component is the dislocation between what the Federal Reserve is telling you they want to do with interest rates versus what the actual market expects interest rates to do. As we sit here, the market expects interest rates to be around 2.5% by the end of this year. whereas the Federal Reserve is telling you they want interest rates to be around 1.9. That disconnect, that aggressive view that the market has towards the Fed's expectation, it's completely irrational at this level. One of those two things has to come in. We have another Federal Reserve meeting in June. The Fed just reiterated last Wednesday that they would only raise interest rates by 0.5% per meeting, and they would raise interest rates based on data at the time of the meeting, which translates, if we continue to see inflation coming down, the trend of inflation coming down, we'll likely achieve the target expectation of around 3.5 or 4% inflation by the end of this year. It's just a time series measurement of what prices have done the trailing 12 months. If we take a look at where the Federal Reserve's own what's called dot plots, and this is a consensus of the voting members on where they want interest rates to be 2 to 3 years down the road. The current interest rates we have in the bond market are sitting literally where the Federal Reserve tells us their consensus interest rates will be. So the bond market has priced in the entire expected Fed raise hike cycle today. That in turn has hurt bond prices. So we find ourselves in a unique position where both pieces of a portfolio are down. Historically, the bond market side of portfolios gives you a buoy and a barrier when the stock market is down. This time's a little different. We saw this very briefly during COVID when the bond market was down at the same time the equity markets were down. We saw this again briefly during the financial crisis, 2008. We saw a very similar environment we're in right now in 1981, when Paul Volcker was very aggressive in raising interest rates to combat inflation and wanted to break inflation. In all these scenarios, the bond market actually began rallying after a pretty severe sell-off to start the year and rallied through the end of the year. Bond market sell-offs don't last anywhere near as long as the equity market sell-offs do. What about the equity market sell-offs? How long do they last? So far, we're sitting at our average duration of post-World War II corrections. You tend to see about 133 days of contraction in the S&P 500 before things begin to turn around. We're at day 128, nearly identical. If you look at the median sell-off post-1980, it's around 18%. We're checking that box as well. What happens during these rate hike cycles is really what's on a lot of people's minds. 3 months after that first rate hike, which started in this case in March, it's been a coin flip on whether the market is actually positive. And so we find ourselves yet again in that territory, that 50% territory. If you zoom out a bit, what happens 12 months after that first rate hike? Modern Fed, post-1980s, 100% of the time the market is actually up. You take a look at what's going on with corporate earnings. If you take a look at what's going on with the consumer, they're actually in pretty solid shape. We're expecting around 10% earnings growth this year, around 9.5% earnings growth for next year. So the path that it takes to get us back to positive correlation with earnings per share direction, which is around 0.94 long term, remains to be seen very, very short term. Markets can become very irrational near term. Once you start to zoom out, portfolio construction has done its job for the past 50 years. We go through these times every 3 to 5 years. Unfortunately, this time does without question feel different. It's a time we've only seen a handful of times past 50 years or so where you have the bond market down at the same time the equity market is down. And so with inflation looking like it could start to cool, and the Federal Reserve having meetings very soon, giving a pretty good indication of what they're going to do with interest rates, you could see some support in the bond market, thus in equity markets as well with expectations. That's all we have this week. Stay tuned for data in the future.